This is Adam Thurgood of Hightower, Las Vegas, with the executive summary version of our Q1 client briefing. There's a longer version on YouTube with a lot more detail if you want to get into it. We've titled this presentation Cross Currents because there are a lot of conflicting global economic and macro forces that we're seeing throughout the world that's making 2023 a tricky investment environment. We certainly have seen one of the most aggressive rate hiking cycles on record, obviously the most aggressive over the past 40 years or so. That has raised rates by 4.5% so far in just about 12 months, much faster and much more aggressive than prior cycles going back into the 90s. And they did this to get inflation under control. Inflation was running rampant, as you can see here. The gray line is producer price index inflation. This is what businesses are paying in inflation. It was up almost 20%. Now we're looking at about 9%. The orange line is core PCE, or personal consumption inflation. This is the Fed's favorite measure of inflation. It's at about 4.4% now. It's averaged a little over 3 going back all the way to the 1960s, but that included the elevated levels of the 1970s. And the Fed really wants to see the orange line down to around 2%. So the question is, have they done enough in terms of tightening to get inflationary pressures down? And number two, how much damage have they done to the economy? And on that front, when we look at leading economic indicators, we are seeing some troubling signs. For instance, the index of leading economic indicators, which is a basket of different indicators that tend to lead the economy, we're seeing it decline to levels that have been typical in prior recessions, which are highlighted by these orange reddish bars. When we look at new orders in the economy, they're down well below 50, which is contractionary territory. And that's a bit of a troubling sign. And also, when we look at the shape of the yield curve, 10-year bonds are paying about 1.2% less than 3-month bonds. And this sets the stage for a recession. This indicator is not a great timer of recessions, but it shows you that the environment is such that a recession could occur. So when we look at everything, are we about to enter a recession in the US? And this is a bit of a mixed bag. When we look at coincident data, we're seeing some positive and some negative signs. For instance, on the negative side of things, banks are tightening their lending standards, which they typically do during recessionary periods. We've seen a big jump in the percentage of banks that are tightening lending standards. But on the flip side, the labor market remains extremely strong. We have not seen the labor market roll over. We're not seeing job losses. Now, this tends to be a bit of a lagging indicator, but when you look at the number of job openings per unemployed person, you can see why there's so much strength in the labor market. We have 1.9 open position per unemployed person. And until this metric comes way down, it's going to be hard to see a lot of job losses happening in the economy. Now, China is also a factor that is becoming more important to analyze. They're coming out of a 3-year lockdown. And as such, we would expect the same sort of demand surge that we saw in the US and Europe and other parts of the world when we came out of lockdown, except their lockdown was even longer. So we're already seeing things like goods and services demand go up in China, flight activity in China is going way up. And this has a positive impact on the Chinese economy and those economies that are directly tied to it, like other emerging markets in Asia and even Europe. But it also creates more inflationary impulses that could push through the globe. So we are facing an environment where China is providing a positive growth impulse while the developed markets of the world are getting close or are already in recession. And that creates a tricky investment environment. And when we look at all the data in our models, we come to a couple of conclusions. And the first is that we think that gold will outperform bonds and bonds will outperform stocks in 2023. Now, this is based on the premise that we will enter a recession at some point in 2023. Central banks have been big buyers of gold. Emerging markets tend to buy gold when their economies are healthy. So China's reopening should provide more positive impulses for gold. Bond yields are now attractive. And if we do go into a recession, bond yields can come down, which would help push bond prices up, helping their performance. And it's tough, at least in the US, for the stock market to perform great if we're heading into a recession. Now, on the stock front, we do see value in the international markets. They're trading at much cheaper valuations than the US. And we think the US dollar is overvalued relative to a lot of these currencies. And as a US dollar investor, you benefit when the dollar weakens and you have money abroad. And then finally, having some dry powder ready to fire, we think makes a lot of sense in an environment where you're getting paid 4.5% to 5% to own some short-term bonds. So we started to raise some cash, put it in 6-month and 1-year treasuries so that we will have that power and we'll be able to deploy it if the environment opens up an opportunity for us. In the words of Bruce Lee, patience is not passive. On the contrary, it is concentrated strength. And we think that it makes sense to have some concentrated strength and dry powder at this point in time to look for opportunities that we think will arise throughout 2023. Again, there's a much more detailed version if you're interested. If not, have a great day.